your number one job is to save the deal, save your investors money. And sometimes that means saying that ugly word, capital call, and no one likes it. The investors won't like it. You won't like it. But again, you're trying to save the asset. That's number one. And then again, if you can make it through 2025 and beyond, then, again, interest rates should be down lower. And then you're going to be just crushing it on the returns.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Kenny Wolfe, and somebody I respect in this business. He's been doing this, 14, 15 years now. Just a lot of great experience that he shares over the next 2 days, a series of shows here. But a little bit about him. He's a founder and CEO of Wolfe Investments, author of Investing in the Dream and How to Acquire Multifamily Real Estate and Attain Total Financial Freedom. I know he shared, during the interview that I think they're over 700 million in assets right now. They're doing numerous asset classes, which we are going to dive into over the next 2 days. I encourage you to listen in and listen to the full interviews, because he shares a number of details that I think, whether you're passive or active, you're going to want to hear about these different asset classes, what they've done, even what, if you're struggling right now, with the deal, maybe you bought a deal within the last couple of years, and you're struggling, you're not sure what to do, he shares some nuggets for you as well, and some things you need to be doing with that deal. Or if you're the passive investor, maybe you need to encourage your operator if some of these things exist in the deal that you need to be taking some action so you can not lose the deal, right? That's our main goal as an operator, is to preserve investor capital, right? And to grow it. So listen to Kenny today. Remember, it's a series, and we're going to jump into another asset class that has received a lot of attention tomorrow as well. Kenny, welcome back to the show. Honored to catch up with you and have you on again. It's been a while. We were just looking it up, and it was you were on show 222 back in the beginning of 2019. So a lot's happened since then, no doubt about it. But you're one of those in the business that I respect in a big way, and you're out there making it happen. And so I love talking to guys and gals like yourself that are very experienced and are doing well, especially in times like this, right? When deal flow's almost non-existent on the multifamily side. I know we're going to jump into that. Why don't you give the listeners, though, a little bit more about your background? It's been a while since you've been on, and maybe you can highlight some of the things in your business, or maybe we'll talk about a few of them, because just so the listener knows, we're going to do a series. We'll do at least a couple shows with Kenny, and highlight some of those moments that have helped you to move forward, in this space and in your business as you go.
Sure. Yeah. So I'll kind of update everybody. We now are at 715 million assets under management today. So we're knocking on the door of the billion mark. That's pretty exciting. We think maybe next year we'll cross over that because a few of we have some development projects that should be delivering starting first quarter next year, and kind of rolling off the assembly line. So we do existing multifamily, like you said. We've done that ever since 2010. So almost 14 years in the space in commercial real estate investing. And then, so 7 years ago, we still buy those today, but 7 years ago, we added 2 arms. So we have a triple net fund, a retail fund. We actually have 5 now. So this is on our 5th fund now. They're great for monthly cash flow, all high credit tenants. So think Dollar Generals, Walgreens, CVS, those kind of tenants in those funds. And then the opposite of monthly stable cash flow is development. So we do both ground up multifamily now in Texas and Ohio. And then we got into the office conversion to multifamily game about 3 years ago, right in 2020. What better time to buy a vacant office building? So now we have 12 of those office conversions going on right now, 2.2 million square feet across the country. 11 of those are for in downtown locations. 1 is in the suburbs. So we're excited about those projects. And like I said, those should start. Our first one should be delivered back to us in January, February of 2024. Yeah,
nice. Give us maybe some of the big moments in your career that were big leaps for you. All right, 2010, you got into multifamily. Was there something then that really set you on a path to success? And maybe a year or two later, or was there anything
Sure.
that stands out to you as man, these are the crucial moments that really pushed me forward?
Yeah, I mean, I think it's it's 2010 was a big move. I came from oil and gas accounting, so I had no background in commercial real estate. But I was I think fairly intelligent. Just surrounded myself with vendors and folks that would help me get to our end goal for our investors. So the management company, picking the right insurance team, all those kind of things, lining those up beforehand, figuring that team out. Definitely shortened the learning curve for us. And then really the other kind of key things were kind of leaning in. And so we branched out quickly. I mean, 3-4 years into it, out to Colorado. So we bought out of state pretty quickly as well to widen our deal flow. And then I'd say 2020 was a big deal for us because I just kept coming to the office. I deemed myself essential. And just kept coming to the office. I stayed home for like a day and couldn't do it with 2 dogs and 2 kids. So anyways, I love them, but it was too loud. I couldn't focus. So anyways, came back to the office and just really grounded out. So we ended up buying a very institutional deal, a deal that should have gone to an institution group buyer in downtown Dallas. And that kind of put us on the map. And then again, we bought our first vacant office building, the Rockefeller building in downtown Cleveland. That also is a splashy kind of headline. But those key deals, when you kind of can lean in at a time when maybe the institutional guys back out, is a way to really move your business in a big way. Because then after those 2 deals, we started seeing all these institutional style deals brought to us. We were kind of invited to the table, so to speak, once that happened. So that was a big deal for us as well.
Nice. No, that's awesome. Leaned in. I love how you express that. It's like institutional deals that maybe not too long before that you may have thought were too big for you. Right.
Exactly. Yeah, absolutely. Yeah.
Yeah. Yeah. Good for you. That's awesome. I love hearing stories like that. Well, let's talk about multifamily a little bit. I know that was your bread and butter, right, for a long time.
Right.
And like most of us, what's your sentiment on multifamily right now? And I know I want to get into how you all pivoted and into some the triple net and office conversions. We're going to talk about that just so the listeners know as well. But where are you at on multifamily right now? Maybe some expectations around multifamily. What are you seeing? And let's talk about it.
It's really strange right now for multifamily. It's a really weird time to be in it. It's been weird for a while, I guess, but this is really strange because what you have now is underlying metrics. So your rents are still going up, your occupancies are really high, but your debt's crazy, or it could be crazy, right? So that's the thing. If you have low interest fixed rate loans, then you have then the grass is very, very green and will be for the next 10, 15 years, whatever it is, foreseeable future. It's the folks that bought in the past, I'd say 20 and 21 and on. If they did a bridge loan, that's fine as long as you bought a rate cap. If you didn't buy a rate cap, then you're being hammered right now by capital costs. I mean, there's just no way to keep up with that quick of a spike in interest rates. And then even those of us that did buy rate caps, what we're watching is, in 2024, 2025, you're going to have these rate cap, your loans are coming up on these bridge loans. So what are interest rates going to be? No one really knows, right? So everybody's kind of watching that very closely on the debt side. But again, your underlying metrics, your rents, your demand is outstripping the supply, and will for decades to come, just because we're so undersupplied as a nation. Some markets are better than others on that, but still, I mean, you've got the wind at your back on that side. So as long as you can figure out the debt side, you're going to be just fine. But there's going to be some pain felt for sure by folks that either didn't get the rate cap or just have bad timing on resetting if they're not stable now, going to a Freddie Fannie loan.
Yeah. Yeah. Those that are, I guess I'm sure you've seen some already that are in trouble, right? I know I have. I've had different people text me and say, "Hey, Whitney, have you know anybody that's done this yet or been through this or done a capital call yet?" Or, and are asking questions because there's definitely some distress, starting. What do you see as some options? I know that like every situation is so different, right? But at a high level, maybe from some that you've heard from already, what are some options for them that you know of, or from that they should be doing right now to maybe not lose a deal, right? Or have to do a capital call?
Right. I mean, so it's all about surviving to 2025 because everybody's basically agreed that interest rates will be lower in 2025. Maybe that starts in 2024. No one really knows. The Fed doesn't even seem to know. It seems like, but now with this war in Israel, it's going to be interesting to see how that affects the Fed as well. But anyway, so everybody's watching that. So for those that are in specific deals, I mean, it's really kind of going to your lenders now before you have trouble. And trying to work out kind of an early extension or something. Again, just your goal is to push that out till 2026, knowing that in 2025, it's all kind of, I guess, understood at the moment that it's going to be back to a big seller's market in 2025, as long as you can survive 2024. So that's really kind of what everybody's trying to solve for now. So you're digging in and like looking at each deal. When's your loan deal due? Hopefully it says 2025 or beyond. If it doesn't, then those are the ones you got to focus on now, and maybe go to your lender, try to get an early extension, try to work with them already before you're in trouble. And like you may have to do capital calls. I mean, no one likes to do that, but right now as a syndicator, I mean, your number one job is to save the deal, is to save your investors money. And sometimes that means saying that ugly word and the ugly phrase, capital call, and no one likes it. The investors won't like it. You won't like it. But again, you're trying to save the asset. That's number one. And then again, if you can make it through 2025 and beyond, then, again, interest rates should be down lower. And then you're going to be just crushing it on the returns since then. So that's really kind of, I don't know, that was a lot to unpack maybe, but that was a long answer. But that's really kind of what we're doing up here now too, is weeding through all that. And then I know other syndicators are as well.
Yeah. No, I loved how you said that, and even placing the first priority on, hey, we're not losing the deal, right? Not losing investor capital, even if it means having to do a capital call. If it gets you through till 25, right? Then
Right.
Hopefully you can still save the deal and save your investors money, right? Even if it means everybody having to put a little more in at the moment. But are you still looking for multifamily deals at the moment? Are you still expecting to be able to close any multifamily deals right now? Is that a focus at all for you all?
So we did close one this year, it was in April. It was a rollover for 2022 though. There just wasn't been a lot of deal flow. I mean, I think I heard a quote that the sales volume is down 75% from last year for multifamily. So you're just not seeing a lot of deal flow on that side. So we really we've seen some, but nothing that is super exciting at the moment. Everybody's kind of sticking to their pricing at the moment. So we actually tested the market on 3 of our assets that are stable, just to see what's the value, what's the market paying these days. And so one of those deals we already went to best and final. It's a deal here in Dallas, Fort Worth, but it's actually our first syndication deal. So we've owned that thing for a very, very long time. We just wanted to test it out because we didn't have to sell it, but we're selling it at about a 5.5 cap. I mean, it's a B class deal. It's nice. It's fixed up. It's stable. So they're able to go to Fannie and Freddie, get fixed interest rate loans, avoid the rate cap. And the other 2 are in Cleveland, Ohio. And again, those are probably maybe only a 5% discount from last year, from 2022. So you're still seeing it. Folks are very, very hungry to do multifamily deals this year. And if you do put one on, like we did, those 3, you're kind of the belle of the ball because there's nobody else out there selling anything. So it was interesting to see that too. And we're going to hit some awesome returns for investors on all 3 of those deals.
Love that. It's incredible. It's nice you don't have to sell them, right? But you can
Right.
go out and test the market like that and see what happens. And it's interesting to hear the turnout, though, of buyers, right, for those deals. And so, congratulations to you. You all making that happen and having some deal flow there. Speak to the when you determine to say pivot into some other asset classes. I know you're doing a few other things now, as well outside of multifamily, like the triple net or the office conversions, and we'll dive into a couple of those. But when were you comfortable to say, hey, let's go tackle this other asset class as well? Outside of, say, your maybe multifamily was your main focus, but you did decide at some point to branch out.
Yeah, so 7 years ago, based around 2017 for both, actually, for the retail fund. We did our first retail fund, bought $7 stores in Texas and Oklahoma. all my investors thought I was crazy. Kenny's lost his mind. He's the multifamily guy buying dollar stores. What's going on? So it took a lot of education. So if you are a syndicator and you're known as a multifamily person, then you jump into any other type of offerings, it's going to be like pulling teeth. And so I think on that first fund in 2017, we only raised like $1.7 million, which at that time we were easily raising 4 or 5 million, maybe more a pop on a multifamily deal within like a couple of days. Right. So it was like pulling teeth. But then it really caught on. So now we've got 61 of those stores. So the 2022 fund, we raised $20 million in that single fund, bought 24 stores in that fund. And those are great. Like I said, they're all high credit. So you're buying those for your monthly cash flow. And so really we had a request from an investor who wanted more, multifamily is great, but it's operational heavy, right? So you have to just chase rents and you have to fix toilets, right? And so it's going to be up and down every month. But they wanted something more stable because they just wanted to roll around their RV, collect ACHs, every month from us. That's very stable. They could rely on it. So basically that was the idea, was to strip out the operational risk as much as we could. So I talked to a guy that was a mortgage broker in the business, Paul Peebles. You guys probably know him with Capital. But I talked to him, asked him, what do people do after multifamily? Thinking that maybe there's some progression there. And he said, they either do medical office or they do triple net, not because you make more money, but because they're a lot less headache. So anyway, so we jumped into the retail side. We love those. Again, all high credit there. And then the development side, that one's a lot more moving parts. And so that one, I just went out myself, bought some townhome lots across the street from our first syndication deal. And then knew I wanted to do a deal that was already zoned. So I didn't have to mess with zoning. I talked to a developer about that. He says, never fight City Hall, just, buy stuff already zoned. And then also too, I wanted a deal where I did have to work with the city a little bit. So so it was 4 townhome lots and I could turn them into 6. And so by the Texas code. So anyways, went there, did that, worked with them, had to present in front of the city hall and the city meeting and everything like that. So it was good practice. Basically built the team, the GC team, and then my team that could manage that process as well. And then, we did that deal, made some good money, and then ended up buying 6 acres and doing an 88 unit ground up multifamily deal. So we could prove it up to our investors that we knew what we were doing. And because it's a 160 step process is what we have it down to. So it's a lot more than your existing multifamily, and definitely way more than like the retail fund. So it's really building your team around you and making sure you have that before you go out and syndicate your first ground up multifamily deal. Yeah.
So you found some development experience to either partner with or bring on the team, I guess, before doing that, or how did you do that?
Then that was the whole idea behind those townhomes. Build those first and get a feel for that, and get comfortable with that process. Because if you can build 6 townhomes, you can do 80, 100, whatever it is. I mean, it's about the same steps. It's just you make more money on the bigger one. So you might as well go bigger.
Yeah, might as well. So how did you narrow down, Paul Peebles said triple net or medical office. What were your thoughts about, those, like medical office or, but you all went into, the triple net, Walgreens, Dollar Generals, those, what were some of the deciding factors and what asset class you were going to move into?
Yeah, I mean, so I like the high credit. I like the guarantee of those Walgreens and Dollar Generals because the parent company guarantees the rent. So since 2017, we've never missed a rent payment at all from any of our tenants. And then even through COVID, we didn't have any kind of rent relief or even a rent reduction request at all on all of our portfolio, because we focused on these high credit tenants, and they were open all through the pandemic, all of our folks. So we really didn't have an issue with that, and I'm glad we did, because there's other folks that I knew in the business that they went into like strip malls, strip centers, and they had a lot of mom and pop owners, and they definitely had rent relief requests and things like that. So they were really kind of nervous throughout COVID, but ours, again, because who we picked on the guarantors and they stayed open, we didn't have any kind of request at all. So I think that was good to stay with those high credit tenants like that on the retail front.
Yeah. No, that's incredible. Great to know that as well. Speak to maybe a couple of things that maybe the passive investor would need to know when they're investing with an operator. in a triple net fund or something like that? What are some questions, if they've always done multifamily, what are some things they need to know about that type of fund?
Sure. Yeah. I mean, I think it's definitely, what's the track record? And also, you need to ask, what's the biggest risk? So the biggest risk to those is buying one store. And that's why we do a fund setup structure. That's the only fund structure we do is because if you buy one store, it could be risky, right? Because it's like buying a single family home. If you're vacant, you're 100% vacant. So it's more risky to buy one house than three. So anyways, that's the thinking, is that we put it into a fund structure. So that was a big deal. The other thing too is, do they have experience repurposing buildings? So we haven't had any go dark since we started. We've done a lot of renewals already, but what we have made a point to do is acquire former Walgreens that now have tenants like Family Dollar, Dollar General. So we have that experience and know kind of what they're looking for, because what we're seeing now is, even if a Walgreens or CVS goes dark, you're seeing these dollar stores want to move up in square footage to those. And then the same thing if you see some Family Dollar or Dollar Tree, and they almost never go dark, but if they do, you're seeing auto parts companies trade up to the space. So what's interesting is no one really reports on it. All these retailers want more square footage. So we all hear this, like Amazon is going to take all the business. Well, Amazon has retail locations now that you can walk into, and then also all these retailers that we've seen, they're trading up when they can for bigger square footage. So it's interesting to see that actually inside on that, and then how high credit are your tenants? So we are 100% high credit. So all of our tenants, except for one at one location, they're all publicly traded. The one that's not publicly traded, they are still high credit. The parent company, it's an LA Fitness outside of Orlando, but they still guarantee the rent. So we are 100% high credit. A lot of folks are maybe 60-70% that are in the business as well. So
okay, so that passive investor, man, they need to know obviously the operational experience of the operator, right? Or have they done this before? No doubt. But I liked what you said. The biggest risk is buying one store.
Right.
Sometimes I think you would maybe even an investor, of a group that they trust. They might want them to the thinking might be, well, I only want them to start with one first, right?
Right.
But man, that could be the opposite of what really needs to happen, right? But I like that how you said that. But and then that's why you did a fund structure, no doubt about it. And what about, I was thinking about that type of project, that type of building. Are you all managing those as well? Probably a lot less management, less hassle, I'm sure, right?
Yeah, it's a lot less management, but you do have to do some. So we did have to create a new management company actually in-house once they hit about, I think, stores for 30. Just because you do, so we get reimbursed for property taxes and insurance. But you still have to pay it and submit it and get reimbursed, and so track that. And then some of these are double net assets. So kind of a worst case scenario is our typically Family Dollars. Those we're responsible for the roof, the structure, the parking lot, and part of the HVAC. And so we have to manage that as well on the CapEx side as well. So it was enough that like I said, I think it was around 30 that we created that new management company. And like you said, it's a lot less, but there's still enough to be where you need some hands-on experience about getting reimbursed and all that.
Yeah. Wow. Okay. And then, I want to dive in more in a moment to the office conversion. I know we've received a lot of questions about that, or people wondering, hey, is that even possible? And they've heard a lot of the issues that you run into. Sounds like you're tackling that head on. But I want the listener to know we're going to jump into that in another segment in just a moment. Kenny, before we do, how can the listeners get in touch with you and learn more about you?
Sure. Yeah. The best place, we're all over social media. So Facebook, the interns finally have me on Instagram. We've got a YouTube channel as well with educational content. But the best place to get a hold of us is Wolfe with an E-investments.com. And that'll get you into our website. And then if you want to join our list or see what we're doing, again, follow us on social media, or drop your email there on the website. You'll get on our list.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.